In this video, we'll be discussing EMA crossovers. There are two types of crossovers when referring to EMA crossovers. The first being when price itself, or the candlesticks, cross over the EMA indicator line. The second is when one EMA line or a series of EMA lines crosses over another EMA line, either to the upside or downside. These crossovers can be used as signals for entry or exit, trailing stop losses, confirmation of trend, or identifying temporary momentum within an overall trend. When we look at price crossing the EMAs, we could see how price reacts when the candlesticks cross the 8 or 9 EMA, the 20 or 21 EMA, the 50 EMA, or the 200 EMA. Let's go back to our ES chart and look at some live examples of price action crossing the EMA indicator lines. Here we are on the S&P 500 E-minis futures 5-minute chart. On our chart, we have both our 8 and 9 EMA. We're using the 5-minute chart with a short-term EMA line to see how price reacts quickly to the shortest EMA known for hugging price the closest. From the data we have on screen so far, we see that this short uptrend lost the EMAs temporarily and found a bottom before continuing higher. We are now seeing price start to cross below the EMAs. This may be used as a signal for entry for us. Let's see how it plays out. When the price has crossed below the short-term EMAs, we may be comfortable entering our position short, and then we could also use the short-term EMAs to tell us when it's time to get out of our trade. On this candle here, the price action crossed back over the 8 and 9 EMA from the underside, signaling to the trader that the temporary downtrend had been lost and it's time to close their trade in profit. We will now look to see how the price action reacts when it crosses the 20 or 21 EMA. Here we have both the 20 and 21 EMA on our S&P 500 E-minis futures chart on the 5-minute time frame. Right now we see that price has crossed underneath the 20 and 21 EMA and may be looking to see the price cross back up over the 20 and 21 EMA to give the trader an entry to go long to the upside. Let's see how it plays out. We see here that the trader could have entered their position at the cross of the 20 and 21 EMA because it is a stronger line of support and resistance. They will now also use the 20 and 21 EMA as their trailing stop loss and exit the position in profit when a full candle closes underneath the 20 and 21 EMA. Because the 20 and 21 EMA are stronger than the short-term 8 and 9-day EMAs, the trader has more confidence in the trend and is able to hold the position longer. At the close of this candle, the trader has decided to exit their position in profit. As we watch price action further, the trader is happy that they collected their profit, as once the price action has lost the 20 and 21 EMA, the price action begins to form a new downtrend. We will now be looking at an example of price action crossing the 50-day exponential moving average. For this example, we are using a 30-minute time frame on the S&P 500 E-mini futures. The reason we are using a larger time frame with a larger EMA is to show how powerful it can be when price action crosses a longer term EMA on a longer term time frame. Here we see the price action starting in a downtrend at the cross of the 50 EMA. The trader notices that the price action is starting to slow and potentially finding a bottom, and they are now looking for price action to cross back over the 50-day exponential moving average as a signal for entry to go long. Let's see how it plays out. The trader is careful to wait for a candle close above the 50-day exponential moving average to enter their position, because they know that the 50-day exponential moving average is a strong bounce line. They enter on this candle and now wait for the price action to cross back below the 50-day exponential moving average to exit their trade. Because it is higher time frame, it may take many days for the price to cross back below the 50-day exponential moving average. The trader is pleased with their entry, seeing that a high time frame chart combined with the cross of a high time frame exponential moving average leads to a strong movement in the upward direction. At a candle close, the trader decides it's time to exit the position in profit. The trader is quite pleased with their entry by combining a high time frame with a high time frame EMA, and nearly 100 points later from their entry, they close their trade in profit. In this example, we will be looking at a price action candlestick cross below the 200-day EMA on a 1-hour chart for the S&P 500 E-mini futures. We are combining the strongest of the EMAs with a high time frame to capture a large move when a major trend is broken. In this example, we will see a trader put on a trade at a candle close below the 200-day EMA with a stop loss at a candle close above the EMA. Let's see how it plays out. At the candle close, the trader decides to enter their position with a full candle close stop loss above the 200-day EMA. They will hold the position until the 200-day EMA is lost and crossed back over by price action. Because this is a high time frame with a strong long time frame EMA, the trader understands that this trade may take many days to play out. So far, they are quite pleased with their entry, seeing that the strong trend in the downward direction is initiated by the loss of the 200-day EMA from price action. With an entry of around 4,100, the trader is deep into profit and waiting now to see if the trend will continue, and holding on to their position, taking profit along the way, and closing out the entire position when price action candles cross back over the 200-day exponential moving average. Though price moves up and down within the move, the trader is confident, knowing that the trend is likely to continue until the 200-day exponential moving average is lost. While other traders may be shaken out of their position as price begins to rise, because the trader entered at a break of the 200-day exponential moving average and will not close their position until the 200-day moving average is lost, the trader is more than comfortable staying in this trade. At a full candle close above the 200-day exponential moving average, the trader decides to exit their trade in profit. After many days and many hundreds of points in the proper direction, the trader is more than pleased with their entry using a cross of price action underneath the 200-day exponential moving average. They are well within their risk to reward ratio at almost 8 to 1.